This video is made to go over the key statutes to help you understand tax foreclosures in Georgia. By the end of this video, you will have a strong foundational knowledge to work the business with confidence. Take good notes and submit questions to the Facebook group. Welcome aboard.
Review of OCGA Section 4841. Procedures for sales under tax levies and executions. This statute outlines the procedures for selling real or personal property under tax levies and executions in Georgia. It ensures that tax sales follow a structured legal process, providing key protections for property owners and interested parties. Here's a breakdown relevant to finders. Notice to the defendant. When a property is being sold under a tax execution, the owner, defendant, must receive at least 10 days' notice of the sale via registered or certified mail or statutory overnight delivery. This applies whether the execution is issued by a state, county, or municipal officer. This notice is crucial for finders tracking tax sales, as it provides a timeline for when the sale will occur, allowing them to prepare to assist in recovering surplus funds. Sale procedures. The sale of property under a tax execution follows similar procedures to judicial sales, ensuring that the process is transparent and legally sound. The sale can be conducted by the tax commissioner, tax collector, or their authorized officers, and may occur in the office of the tax commissioner or another designated location. Aggregation of executions. If multiple tax executions are levied against the same property, they can be aggregated into one sale. This means all outstanding tax debts can be resolved in a single transaction, and the 12-month redemption period begins for all executions from the date of that sale. Finders should be aware that the aggregation of executions can affect the total debt and redemption process. Property description in advertisements. The statute allows for the property to be described in advertisements using the tax parcel identification number and current street address, rather than requiring a full legal description. This streamlined approach to advertising tax sales makes it easier for finders to locate and track properties that are up for tax sale. For finders, OCGA Section 4841 is a key statute to understand, as it details the process by which properties are sold for delinquent taxes. It highlights important elements like notice requirements, aggregation of executions, and sale advertisements. Knowing these procedures helps finders monitor the timing and legality of tax sales, providing opportunities to assist in recovering surplus funds from sales that exceed the tax debt. Review of OCGA Section 4843. Duties of levying officers. This statute outlines the duties and responsibilities of levying officers, including constables and other authorized personnel, when handling tax executions issued by a tax collector or tax commissioner. Key points for finders are as follows. Authorized enforcement. Tax collectors or commissioners can delegate the enforcement of tax executions to a constable or any other levying officer within the county. These officers are responsible for collecting delinquent taxes or levying property to satisfy the execution. For finders, this process is part of the tax sale pipeline, as levying officers are the ones initiating the actions that could lead to surplus funds being generated from the sale of tax delinquent properties. Timely execution. Once the tax executions are handed over to the levying officer, they must act promptly to enforce collection through levy and sale. This prompt action ensures that properties do not sit idle in tax delinquency for extended periods, helping to create opportunities for tax sales and potential surplus funds. 90-day settlement period. The levying officer must settle with the tax collector or commissioner within 90 days of receiving the tax executions. This involves collecting taxes or conducting sales and returning any uncollected executions with appropriate entries. Finders should note that this 90-day window is an important part of the tax sale process, as it governs how quickly sales might occur and when surplus funds may become available. Penalties for noncompliance. If a levying officer fails to make a final return or settlement within the 90-day period, They forfeit their right to costs from the executions and can be compelled to account for their actions in court. This ensures accountability in the tax collection process. For finders, OCGA Section 4843 is important because it establishes the timeline and responsibilities of those handling tax executions. Understanding this process helps finders track when tax sales are likely to occur and when surplus funds might be available for recovery, as levying officers are key players in moving delinquent properties through the tax sale process. It's important to note that the majority of this information is to assist in your knowledge of the overall picture and help you grow as a professional. You can make an inquiry with the tax commissioner to find out when their tax sales occur. Understanding these statutes will help you in your discussions with former owners on explaining the process when needed. Review of OCGA Section 4845. Payment of excess funds. This statute governs the process of handling excess funds from a tax sale, which are any funds remaining after all taxes, costs, and expenses have been paid. The statute is highly relevant for finders who assist property owners in recovering these funds. Key points include: notification of excess funds. After a tax sale, if there are excess funds, the tax commissioner, tax collector, sheriff, or other officer must give written notice to the record owner of the property and any parties with a recorded interest such as lien holders. The notice must be sent within 30 days of the sale by first-class mail and include details such as the property description, sale date, sale price, amount of excess funds, and contact information for the tax sale purchaser. This requirement ensures that all relevant parties are informed about the availability of excess funds, creating an opportunity for finders to help claimants recover those funds. Interpleader action. If there are competing claims to the excess funds, the tax commissioner or other officer may file an interpleader action in Superior Court to distribute the funds. The court will determine how the funds are to be distributed based on the order of priority of the parties' interests such as lien holders and property owners. Finders should be aware that in cases of disputes, legal intervention may be required to resolve who is entitled to the excess funds. Unclaimed funds. If the excess funds remain unclaimed for 5 years after the tax sale and no action has been taken to claim them, the funds are transferred to the Georgia Department of Revenue. Once in the possession of the department, only a court order from an interpleader action can release the funds. This 5-year window is very important for finders, as it highlights the timeline in which claimants should act to recover surplus proceeds. For finders, OCGA Section 4845 provides a clear roadmap for tracking and recovering surplus funds generated from tax sales. By understanding the notification process, legal proceedings for disputed claims, and the 5-year limitation for unclaimed funds, finders can effectively assist property owners and other parties in securing their rightful excess proceeds from a tax sale. Tax commissioners will file interpleader in the local court if a finder attempts to collect excess proceeds. It's highly recommended that finders work with an attorney in Georgia. When a finder attempts to collect surplus funds on behalf of an owner, this opens up to possibility that multiple parties are owed the funds. When this happens, it becomes unclear to the county who the funds should be distributed to, so they automatically hand the distribution duties to the court. As for the excess proceeds, most of them are online, and to obtain the list from Fulton County, you want to submit public records request to the sheriff. For newer foreclosure tax sales that just happened, if the sheriff does not have the updated list, it is probably still being worked on by the county. Review of OCGA Section 4846. Validity of deed made at tax sale. This statute confirms the validity of deeds or bills of sale issued by the sheriff following a tax sale. It establishes that such deeds hold the same legal standing as those executed under an ordinary court order from the Superior Court. Key points include: equal validity. A deed or bill of sale issued after a tax sale is considered legally equivalent to a deed issued through a judicial process in the Superior Court. This ensures that the purchaser of the property receives a valid and enforceable deed, providing them with full ownership rights to the property. Legal certainty for purchasers. By equating the validity of tax sale deeds with superior court executions, this statute provides legal certainty for purchasers, making the transfer of ownership through a tax sale as secure as any other court-ordered sale. This stability is important for both buyers and those handling surplus funds, as it ensures that the sale was legitimate. For finders, OCGA Section 4846 is important because it affirms the validity of tax sale deeds, ensuring they are legally enforceable. While the sale is subject to the redemption period, any excess funds from the sale are legitimate and can be pursued by interested parties. This provides finders with confidence in assisting with the recovery of surplus funds based on a solid legal foundation. It is recommended that finders focus on surplus funds after the redemption period has expired. For those working on pre-foreclosures or during the redemption period, the property owner may have the option to forfeit their right of redemption in exchange for the surplus proceeds. Review of OCGA Section 48440. Persons entitled to redeem land sold under tax execution. This statute outlines the right of redemption for individuals whose property has been sold at a tax sale. It specifies who can redeem the property, the timeframe for redemption, and the process involved. Key points for finders include: who can redeem? The right to redeem the property extends beyond just the original owner, the defendant in fieri facias. Any person with a right, title, interest, or lien on the property, such as a creditor or other interested party, can also redeem it. This is important for finders, as it highlights the potential for multiple parties to have redemption rights. Redemption timeframe. The statute establishes a 12-month redemption period starting from the date of the tax sale. However, the right to redeem may continue beyond the 12 months, as it remains open until the purchaser forecloses the right by providing the appropriate notice under OCGA Section 48445. This means that even after the first year, the right to redeem exists unless the new owner takes specific legal steps to terminate it. Redemption process. To redeem the property, the interested party must pay the required amount as outlined in OCGA Section 48442, which includes the sale price, interest, and additional costs. This allows the property to return to the original owner or lien holder, nullifying the tax sale. For finders, OCGA Section 48440 is very important because it defines the redemption window and clarifies who may exercise this right. While the one-year redemption period is standard, the possibility of extended redemption due to foreclosure procedures means that finders should carefully track each case to determine when surplus funds can be pursued. Additionally, understanding the parties entitled to redeem helps finders navigate potential claims during the redemption process. Always check with the Georgia's Clerk's Authority to verify legal documents connected to the property. The name of the website is Georgia Superior Court Clerks Cooperative Authority. GSCCCA.org. Review of OCGA Section 48442. Amount payable for redemption, additional costs. This statute outlines the amount required to redeem a property following a tax sale and specifies the additional costs that may be incurred. For finders, understanding these details is essential when assisting property owners or interested parties in reclaiming their property during the redemption period. Key points include: base redemption amount. To redeem a property sold at a tax sale, the person redeeming must pay the amount paid for the property at the tax sale, as stated in the tax deed. Additionally, the redeemer must pay any taxes the purchaser paid after the sale, any special assessments levied on the property, a premium of 20% for the first year or fraction of a year since the sale, and 10% for each additional year or fraction thereafter. Additional costs after notice. If the redemption is made more than 30 days after the notice provided under OCGA Section 48445, which forecloses the right to redeem. The redeemer must also pay sheriff's costs for serving the notice, any publication costs, if applicable, homeowner and property association fees. For sales after July 1, 2016, additional costs include any fees paid by the tax sale purchaser to property owners associations under OCGA Section 443232, condominium associations under OCGA Section 443109, homeowners associations for planned residential subdivisions. Payment method. All amounts must be paid in lawful U.S. currency directly to the tax sale purchaser or their successors. For finders, OCGA Section 48442 is important because it clarifies the costs involved in redeeming a property from a tax sale. Understanding the exact amounts required for redemption helps finders guide property owners through the process of reclaiming their property and assists in estimating potential expenses associated with the redemption. It also helps finders assess when the redemption period is likely to end, signaling when surplus funds might be available. Review of OCGA Section 48443. Effect of redemption. This statute explains the legal effect of redeeming a property after it has been sold at a tax sale. It highlights how the title and liens are handled once redemption occurs. Key points include restoration of title. When a property is redeemed, the title that was transferred to the purchaser at the tax sale is returned to the original owner, defendant in fieri facias, subject to any existing liens that were in place at the time of the tax sale. This means the property owner regains their ownership, but any prior liens, such as mortgages, remain attached to the property. Redemption by creditors or interested parties. If a creditor or another person with a legal interest in the property redeems it, the amount they paid to redeem the property becomes a first lien on the property. This lien takes priority over all other claims. Recording the quitclaim deed. For the lien held by the redeeming creditor or interested party to be enforceable, the quitclaim deed provided under OCGA Section 48444 must be properly recorded. This ensures the lien is documented and will be repaid before any other claims on the property. For finders, OCGA Section 48443 is important because it clarifies what happens to the title and liens after redemption. While finders are not assisting with redemption directly, they should understand how redemption affects ownership and liens, as it may impact surplus funds and the ability to answer homeowner questions about title restoration and potential lien claims. Review of OCGA Section 48444. Quitclaim deed by purchaser. This statute details the process by which a quitclaim deed is issued when a property is redeemed after a tax sale. It outlines the responsibilities of the tax sale purchaser and the steps required to properly document and record the redemption. Key points include issuance of a quitclaim deed. When a property is redeemed, the purchaser at the tax sale must issue a quitclaim deed to the former owner, defendant in fieri facias. The deed must include the name of the person who paid the redemption amount, the legal claim or interest under which the redemption was made, prima facie evidence. The details provided in the quitclaim deed serve as prima facie evidence of the stated facts, meaning they are presumed to be true unless proven otherwise. Execution of the deed. If the quitclaim deed is presented to the purchaser at the time the redemption payment is made, the purchaser must sign it if a notary public and an unofficial witness are present. If no deed is presented at that time, or witnesses are unavailable, the purchaser has 7 days to prepare and execute the deed. Recording of the deed. Once the quitclaim deed is properly executed, the purchaser has 10 days to present it for recordation with the court clerk in the county where the tax sale occurred. The purchaser is responsible for paying the recording costs and returning the recorded deed to the redeemer. For finders, Understanding OCGA Section 48444 is essential because it outlines the formal process for transferring property back to the original owner once the property is redeemed. While finders are not involved in helping with redemption, this statute helps them explain the procedural steps to homeowners when discussing redemption timelines and legal processes. Additionally, it ensures finders are aware of the legal obligations the tax sale purchaser has in finalizing the redemption and property transfer. Review of OCGA Section 48475. Legislative findings. This statute provides the legislative framework for addressing the non-payment of ad valorem taxes and the problems it creates for property owners, neighborhoods, and local governments. The General Assembly highlights several key concerns. Increased tax burden. When property owners fail to pay their taxes, the financial responsibility shifts to those who do, creating an inequitable tax burden. Barriers to revitalization. Tax delinquency can hinder the revitalization of neighborhoods, making it difficult for communities to grow and improve. Challenges in property marketability. Significant tax delinquency results in properties that are difficult to sell, as non-judicial foreclosure often leads to titles that are neither marketable nor insurable. Public health and safety hazards. Many tax delinquent properties can deteriorate and present hazards to the public, further emphasizing the need for action. The statute emphasizes the inefficiency of non-judicial tax foreclosure procedures and supports alternative foreclosure methods to more effectively return tax delinquent properties to productive use and back onto the tax rolls. For finders in the tax excess proceeds industry, this statute underscores the importance of tax sales in stabilizing communities by resolving delinquent properties and potentially freeing up surplus funds after sales. This is an opportunity for finders to assist homeowners in claiming these surplus funds once their tax delinquent property is sold and revitalized under the procedures set by this article. The legislative intent here is not about protecting property owners from foreclosure, but rather ensuring communities are safeguarded from the negative impacts of tax delinquency while giving finders a role in facilitating the recovery of excess proceeds. Review of OCGA Section 48476. Judicial in rem tax foreclosures. This statute outlines the judicial in rem tax foreclosure process, a legal mechanism that allows counties and municipalities in Georgia to enforce tax liens on delinquent properties. Here are the key points relevant to finders in the tax excess proceeds industry. Judicial in rem foreclosures. The statute grants local governments, counties and municipalities, the authority to foreclose on properties with delinquent taxes through a judicial process, focusing solely on the property itself rather than pursuing personal liability from the owner. This means the property is the subject of the foreclosure, not the homeowner personally. For finders, this indicates that properties foreclosed through this process may result in surplus funds if the sale price exceeds the tax debt. Local ordinances and resolutions. Counties or municipalities must pass an ordinance or resolution to adopt the judicial in rem foreclosure process. If a county does not enact such an ordinance, individual municipalities within that county can still proceed with their own resolutions. Finders should be aware of the local legal framework and whether this process is in use in the area they are working in, as it affects how tax foreclosures are handled. Limited to tax liens. This process is strictly for enforcing ad valorem tax liens and does not involve any personal liability for the property owner. This means the focus is on recovering unpaid property taxes rather than other debts, a key consideration when assessing potential surplus proceeds from the sale. No extension to tax lien buyers. The rights granted under this statute are reserved solely for government entities that collect taxes. Private parties who purchase tax liens or tax executions cannot initiate these judicial foreclosure proceedings, keeping the process within governmental control. Joint or independent action. Counties and municipalities can initiate these foreclosures independently or jointly, depending on their agreements. This joint action flexibility could affect the scale of properties involved in the foreclosure and subsequent potential surplus funds. For finders, understanding this statute is important because it details the foreclosure method used to resolve tax-delinquent properties, which may result in surplus proceeds. Since the property, rather than the homeowner, is the focus of the foreclosure, any excess from the sale beyond the tax debt becomes an opportunity for finders to assist the former property owners in reclaiming those funds. Review of OCGA Section 48478. Identification of properties with delinquent ad valorem taxes. Petition for tax foreclosure, notice requirements. This statute outlines the procedures for initiating judicial in rem tax foreclosure proceedings on properties with delinquent ad valorem taxes. It is highly relevant for finders assisting with the recovery of surplus proceeds from tax sales. Key takeaways include property identification and timing. Once a tax lien becomes delinquent, after 12 months of non-payment, the tax commissioner or tax collector can identify properties to commence foreclosure. This timeline is important for finders as it marks when properties may be listed for tax sale and the potential creation of surplus proceeds. Petition filing. The tax commissioner or collector must file a petition with the Superior Court to begin the foreclosure process. The petition includes essential information such as the property address, tax identification number, years of delinquency, and the amount of unpaid taxes, interest, and penalties. Finders should be aware of these filings, as they indicate the foreclosure process has begun and the potential for surplus funds. Notice to interested parties. The statute requires that the tax commissioner send notice of the petition to all interested parties, such as property owners and lien holders, by certified mail or statutory overnight delivery. This ensures that all parties with a legal interest in the property are informed. For finders, knowing when and how these notices are sent can help track the progress of the foreclosure and prepare to assist with surplus recovery. Lien pendens filing. Simultaneously with the petition, a notice, lien pendens, must be filed in the county records, alerting the public to the pending foreclosure. This notice further establishes the legal status of the property and provides another point of reference for finders monitoring tax sales. Public notice. The petitioner must also publish notice of the foreclosure filing in the official county organ on 2 separate dates, including all relevant property and tax details. This public notice provides an opportunity for finders to stay updated on upcoming foreclosures and potential surplus recovery opportunities. For finders, this statute outlines the formal steps that lead to tax foreclosure, creating a clear roadmap for when properties become eligible for sale and surplus proceeds. Understanding this process is vital for tracking properties in foreclosure and identifying cases where excess funds may be available for recovery, enabling finders to assist homeowners in claiming those funds once the tax sale is complete. Review of OCGA Section 48479. Judicial hearing on petition, orders, priority of claims, death of interested party. This statute outlines the judicial process and hearings involved in tax foreclosure proceedings once a petition is filed. It provides guidance on the rights of interested parties and the court's role in confirming the sale of the property. Key aspects relevant to finders are as follows. Judicial hearing. The petitioner must request a judicial hearing at least 30 days after filing the foreclosure petition. During this hearing, any interested party, such as property owners or lien holders, has the right to contest the delinquency or adequacy of the proceedings. For finders, this is important because it establishes when the court will officially determine if the property can be sold, potentially leading to surplus funds. Court judgment and orders. If the court verifies the accuracy of the petition, it will issue a judgment confirming the delinquency of taxes and the validity of the foreclosure process. The court will order the sale of the property. The sale becomes final and binding 60 days after the sale date, marking the conclusion of the foreclosure. This timeframe is very important for finders tracking surplus funds, as any excess proceeds from the sale may be available after this finalization. Sale free of liens. The court's order will direct that the property be sold free of liens, claims, and encumbrances, except for certain exemptions like federal redemption rights, superior tax liens from other Georgia governmental entities, easements, and real covenants. For finders, this ensures that the property is clear of most prior claims, which could increase the likelihood of surplus funds being generated from the sale. Death of interested party. If an interested party has died within 6 months of the filing of the petition, the court may delay the hearing for up to 6 months. This gives time for the executor or administrator of the deceased's estate to handle the estate matters. Finders should be aware of this possible delay, as it could affect the timeline for recovering any surplus proceeds. For finders, OCGA Section 48479 provides insight into the judicial process behind tax foreclosures, outlining when the court will authorize the sale and how claims and liens are prioritized. By understanding the timing of court orders and the potential for surplus funds, finders can better assist property owners in recovering excess proceeds following a tax sale. All of this is good information to learn about the industry so you can become a professional, but Georgia is one of the states that has many excess proceeds lists from tax sales online for everyone's review. The information you learn will come in handy when you speak with homeowners and they ask you questions about this process. All of this is good information to learn about the industry so you can become a professional, but Georgia is one of the states that has many excess proceeds lists from tax sales online for everyone's review. The information you learn will come in handy when you speak with homeowners and they ask you questions about this process. Review of OCGA Section 48480. Redemption by owner or other interested party. This statute outlines the process by which a property may be redeemed by the owner or other interested parties prior to the tax sale, and the consequences of such redemption. Key points for finders include: right to redemption. Before the property is sold, any interested party, including the property owner, can redeem the property by paying the delinquent tax amount to the petitioner, typically the tax commissioner or tax collector. If the redemption occurs, the tax foreclosure proceedings are dismissed. For finders, this signals that if the property is redeemed, there will be no surplus funds to pursue since the sale is halted. Owner redemption. If the owner of the property redeems it by paying the delinquent taxes, the foreclosure process is dismissed, and all parties' rights and interests in the property remain unchanged. This emphasizes that no excess proceeds or other opportunities for finders exist in such cases, as the foreclosure and potential sale are avoided. Redemption by other interested parties. If an interested party, other than the owner, redeems the property, they gain a lien on the property for the amount they paid to redeem it. This lien has the same priority as the delinquent tax lien, but the lien holder does not take over the petitioner's rights. The redemption effectively stops the sale but introduces a new lien holder, which could impact any future foreclosure process. For finders, this provision means that the foreclosure is halted, but the redemption process could lead to further opportunities later if the new lien holder initiates another action. For finders, OCGA Section 48480 is significant because it highlights that redemption can prevent a tax sale and the creation of surplus proceeds. However, the statute also clarifies the rights of other interested parties who may redeem the property, potentially affecting future foreclosure opportunities. Understanding this process helps finders track when a sale might or might not occur, depending on redemption actions. Review of OCGA Section 48481. Sale procedures. Time. Minimum bid. Finality. Right of redemption by owner. Execution of tax deed. Report of sale. This statute details the procedures for selling tax-delinquent properties following a judicial order, the finality of the sale, and the rights of owners to redeem the property. It is important for finders to understand the timelines and processes that lead to surplus funds being available. Key points include sale procedures. After the Superior Court orders a tax sale, the sale must be advertised and conducted similarly to a sheriff's sale. The sale cannot occur sooner than 45 days after the court's order. This period is vital for finders to monitor potential surplus funds from upcoming sales. It is important to note that the information being discussed has to deal with judicial court foreclosures. This is not the normal foreclosures. Both have their own rules, and if the foreclosure is processed through the court system, they may have a shorter redemption period. Minimum bid. The minimum bid for the property is the redemption amount, the amount owed in taxes, interest, and penalties. If there are no higher bids, the petitioner, usually the tax commissioner, may place a bid but is not required to. Finders should note that if a property is sold for more than the minimum bid, any surplus funds may become available to the property owner or interested parties. Finality and right of redemption. Once the sale occurs, it is final and binding. With one exception, owners have a 60-day redemption period where they can reclaim their property by paying the full bid amount into the Superior Court. If the property is redeemed, the foreclosure proceedings are dismissed, and the purchaser is refunded. Finders should be aware of this redemption window, as it affects when any surplus funds are released. Execution of tax deed. If the property is not redeemed within 60 days, the petitioner must deliver a tax deed to the purchaser within 90 days. This tax deed transfers ownership of the property to the purchaser. This process finalizes the sale and confirms the ownership change, after which surplus funds may be distributed. Report of sale and surplus funds. Within 90 days of the sale, the petitioner must file a report with the Superior Court detailing the sale and the identity of the purchaser. If the sale price exceeds the minimum bid, the surplus is deposited into the court's registry. The court will distribute these funds to the interested parties, including the former property owner, based on their respective claims and priorities. This is where finders can assist the owner in recovering those surplus funds. For finders, OCGA Section 48481 is very important, as it outlines the exact process for tax sales, the creation of surplus funds, and how those funds are distributed. By tracking sales, understanding redemption periods, and monitoring court filings, finders can identify opportunities to assist property owners in recovering any excess proceeds from tax sales.